First of all, it's important for us to remember that we measure economic activity in the United States with something called real GDP. Now, it's important for us to remind ourselves what is real GDP. And you can see the results of GDP over the last couple of years, the huge decline in the second quarter of 2020, huge recovery in economic activity in the third quarter of 2020, and then pretty consistent growth in our economy in the 3 quarters following that. We'll get the third quarter real GDP report next week. So I'm going to have a forecast here that incorporates at the end of this about what that number is going to be. I was hesitant to do that. I've been wrong a lot in my life, but seldom as quickly as within 1 week. But I did put that forecast in, and we'll see what happens when it comes out next week. Now let's remind ourselves what real GDP is. First of all, real GDP is the sum in dollar terms of spending, consumption in this country. It's made up, first of all, of personal consumption expenditures, which, as you can see, represents 70% of our total economy. So 70% of economic activity is a result of the consumer spending that takes place over any period of time. It's what you and I spend money on and buy over a course of time. The second category would be capital spending, and that's what companies spend money on. Plant and equipment, productivity enhancing efforts, computers, all of those kinds of things go into the capital spending category, as does residential real estate activity. So residential real estate activity, buying houses, is considered a capital expenditure. Thirdly is government spending. What is the government spending? What consumption are they executing over any period of time? You add those 3 up, and that is the dollar level of economic activity in a certain period of time. Now, there's a couple of things that we have to take into consideration. First of all, we have to look at what inventories have done. If inventories decline, then the consumption activity for that period was not met with an increase in production or output. So we basically, when you draw down inventories, you're not creating economic activity in the periods you're measuring. That activity took place in a prior period when the inventories were being built. So it's a plus or minus number to the sum of those 3 spending categories. And then finally, we have to consider the trade deficit, because clearly if we buy things that are imported into this country from other markets overseas, that's not an economic activity in the United States. So if you look at this, you can see that in the second quarter of this year, we saw a significant decline in inventories, $168 billion drawdown of inventories. So given the demand levels and the rise in consumption and purchasing that occurred as the economy has recovered, a lot of that activity was satisfied by companies selling out of inventory. In essence, companies have had a real difficult time getting production up enough, output up enough to meet the rise in current demand, and therefore have had to sell out of inventories. Now, in addition to that, we also did obviously a significant negative in the trade deficit, and we're going to talk a little bit more about that. We satisfied a lot of domestic consumer spending and corporate spending with imported goods. That's not an economic activity in the United States, so we subtract that. And then on top of all that, in order to get to real GDP, we have to factor out inflation, because what we're really trying to measure is the unit activity that's taking place in this country and not incorporate price increases, because it's a dollar measure. So to get to real GDP, they factor out the inflation that existed in the time period being measured. So that's what real GDP is. Now, if we look at the growth in those categories, what I did is I went to the second quarter of 2020, which was the really low point in the economy, if you remember the first chart. and measure the change in each of these categories from that second quarter of 2020 to the second quarter of 2021. So we're really measuring from the low base that we sunk to at the height of the pandemic and the closing of the economy. And as you can see, consumer spending, personal consumption expenditures have grown 16.2% in that 12-month period. Capital spending up 12.3%. Government spending, surprisingly, is actually down in the second quarter of this year as opposed to the second quarter of last year. That has more to do with the timing of when the stimulus checks and the government sent out all the programs or executed the programs that we're going to talk a little bit about in a minute. But it actually has declined a little bit. Change in inventories was a whopping $252 billion in the second quarter of last year when we shut the economy down. It's only declined by $168 billion in the second quarter of this year. So at least the inventory drawdown was less this year than it was last year. But look what happened to the trade deficit. Trade deficit's up 60% over that 12-month period of time. We clearly have satisfied a significant portion of the increase in final demand by consumers and companies with imported goods. So we can talk about the supply chain disruption all day and how many ships are parked off the coast of California, but the reality is we have satisfied a significant portion of the demand with imported goods over the last 12 months. If I look at the percent of total real GDP represented by personal consumption expenditures, that's the 70% of the economy, you can break that down into two categories, services and goods. So I'll give you an example quickly. If you buy food at a grocery store, that's in the goods category. If you go to a restaurant and eat a meal, that's in the services category. So it depends on the nature of the spending, is whether it's categorized as goods or services. This economy over the last 50 years has been transitioning from a goods economy to a service economy. So the service economy is much larger than the goods economy. As you can see, as a percent of total personal consumption expenditures, the services represented 60% of total personal consumption expenditures, and goods 39.9%. And of total GDP, the 70% is broken down 42 and 29. So there's a reason I did this, because we want to see what the impact has been in the last year to each of these categories, services and goods, that have occurred. Now, the economy has grown at a pretty rapid pace. It's been fed by the growth in personal income, fueled, if you will. Personal income has grown at a much faster pace over the last actually 15 months than historically we've experienced in the past. It's been aided by a number of things, the income growth. First of all, there's a lot of people who've received pay increases, wage increases. They got paid even though they were working from home. There were a lot of people who ended up with significant increases in their incomes just from the job they had. We added on top of that the stimulus programs, where we started sending checks out to a whole lot of people. And I said I wasn't going to get this political, but I'll give you an example of how, I almost said stupid, but it is stupid. The government a year ago said to, and I happen to be over 72, I know it's hard to believe, but I am. I got more laughs at that than anything else. The government said I didn't have to take my RMD, my required minimum distribution, out of my IRA last year, that I could keep the money in it and wouldn't be a problem. So I didn't. Fortunately, I didn't need the money, so I left it in the IRA. Because of that, my taxable income dropped below the line at which you could get the stimulus checks. So the government sent me a check for $2,800. $1,400 for me, $1,400 for my wife. Now, does one hand know what the other hand's doing? On the one hand, they say, don't take your RMD, leave it in the RII. And on the other hand, they're going to send me a check. That's the problem when you get government making these kinds of social decisions mixed with economic necessity. That we end up with this misallocation of these kinds of resources. Now, just to finish the story, I did give the $2,800 to my church. I didn't keep it myself, but I certainly didn't need the $2,800 last year. But they sent it to me, and have you ever tried to send money back to the government? You can't do it. I mean, essentially, it's impossible to do. But that's the kind of events that have occurred over the last 15 months that have caused personal income to rise at the level that it has. Now, what have people done with that money? First of all, they've saved a significant portion of it. As you can see, the huge spike in the savings rate that occurred especially in 2020 for several reasons. One, incomes were rising, they sent stimulus checks, but two, expenditures were down. When you work from home, you're not buying gas to drive to work, you're not buying clothes that you might have to wear in the workplace, you're not eating lunch out, you're not doing a lot of things when you work from home that you would normally do that cost you money. So as a result, the incomes are going up, expenditures are down, I get to save a lot more money. You can see the savings rate, actually the peak in the savings rate was in April of 2020 at 33% for the month. Now it's 25% for the quarter, but 33% for the month. The savings rate has begun to come down as we've opened the economy back up. The savings rate in this country averaged just a little bit over 7% a year from 2010 through 2019. So we kind of view that as the base period for measuring a change in the savings rate. In the second quarter of this year, it got back down into that 7% area. And the question really is that going to continue? Is the savings rate going to be 7%? Is it going to be 10%? Or is it going to be 3% going forward? And that's one of the unknowns that we have. One of the impacts of this savings rate increase is banks are flush with cash. All of that liquidity and less spending has ended up in bank deposits. Every bank is loaded with deposits. So even when interest rates start to go up, the probability of seeing banks offering higher deposit rates or rates on deposits are going to be delayed. There's going to be a big lag between a change by the Federal Reserve in interest rates and changes in bank deposit offering rates, because the banks are trying to work that cash back into the system into reasonable earning assets. But that's one of the impacts that we're going to see. The good news on that is it probably keeps loan rates lower than they would otherwise be, because banks are trying to grow their loan portfolios. Did I say that without giving away any secrets about Citizens Bank?
That was a good answer.
Thank you very much. All right. Try not to offend the sponsor. So one of the things people did is increase their savings during this, with all this money that came in. But if we look at the growth in components of personal consumption expenditures, you can see the growth has been in the goods sector. It's not in the service sector. Which sector of the economy did we shut down? We shut the service sector down. Closed restaurants and bars and travel and hotels and everything else when the pandemic was at its peak. So the service sector spending is the one that's been the weakest and the slowest to come back, even though it's the largest segment of personal consumption expenditures. People took money and bought goods. They went out and bought new appliances, new furniture, renovated a house, did a lot of things where they used money where they bought goods. That's exacerbated. I love a liberal arts education. That's made even worse the supply chain disruptions, because we got this huge increase in demand while companies were still shut down, or in many cases restricting the amount of production or output they were doing. Now, and finally, we saw this huge increase in the trade deficit. So people have had to buy imported goods because the goods sector was by far the fastest growing segment of that personal consumption expenditures. So we end up in the environment we're in today, which is supply chain disruptions. The fear is we're not going to have products to buy this Christmas, that the shelves are going to be empty, that we're not going to be in a position to satisfy the demand for goods because of the supply chain disruptions. And therefore, we have to get imports to go up. Now, if the increase in the trade deficit, widening of the trade deficit, is certainly evident when you look at imports. Look at the growth in imports in the last few quarters. We are certainly buying a lot more of the goods we want to own with imported goods. Okay? Industrial production, which is a measure of the output that we're manufactures, has recovered, but it's still below the level. Industrial production indexes are still below the level of where they were prior to the pandemic. So we have not gotten back to building in this country the products that are in demand. And that's going to be a problem. There's a couple reasons for that, and I'm going to go through those very quickly here in a minute. So we end up in this environment where inventories get drawn down because companies are meeting the demand for products by selling out of their inventories. We're importing more goods to meet that demand, and we're not increasing output, production of goods at the rate we have to grow it in order to address this supply chain issue. So the supply chain issue continues to be a problem and will continue to be a problem as we go forward. Now, what's causing the supply chain problem? First and foremost is the labor market. And the real question, I don't know if you noticed when I had the slide up there at the beginning of this presentation, I called this presentation a change in the paradigm. And here is the big question we have. Has there been a permanent change in the nature of the labor markets in the United States? Why can't we get people to take jobs? Why can't we get people to come back to work? And the numbers are shocking when we look at it. In this case, I'm looking at average hourly earnings, and as you can see, the red line is the civilian unemployment rate, and the blue line is the average hourly earnings in industry. Earnings are, if you look at on the far right-hand side, the blue line, earnings are starting to go up. Average hourly earnings are rising at a pretty healthy pace as unemployment has declined. The Federal Reserve is charged by Congress by law to conduct monetary policy with two specific mandates. The first mandate is conduct monetary policy so as to promote full employment. And the second mandate is to conduct monetary policy and maintain price stability, which means control inflation. Okay? Of those two mandates, the Federal Reserve has basically been unbalanced in the last 2 years. They have said, we're willing to accept more inflation in order to reach full employment. And therefore, they've been unbalanced between those two mandates. And the position the Federal Reserve has taken is that any inflation that we experience as a result of their decisions will be temporary or transitory in nature. In other words, inflation may spike, but it won't last very long. That's their position. Well, we're quickly coming to realize, and we're going to look at inflation in a minute, that may not be a valid assumption by the Fed. And the Fed may have to change course, largely because inflation is rising and will probably continue to rise all through next year. Part of which is because labor costs are rising. The ability for companies to attract workers means they have to raise wages. They have to raise the wages they're willing to pay. Who wants to go to work at McDonald's at $8 an hour when I can go to work for UPS or Amazon, both entry-level positions, unskilled labor, at $18 an hour, get college tuition and full health benefits as soon as I start. The reality is, nobody wants to work at McDonald's when they have that alternative to work for Amazon or UPS or FedEx or many of these other companies. Even the retailers, Walmart's, Target's, companies like that have raised their starting wages to the $15 to $18 an hour range. So this wage growth that you're seeing, average hourly earnings, is only going to accelerate at an even faster pace going forward because so many companies are having such difficulty in finding workers. And I suspect that most of the people in this room are experiencing that in their own businesses, trying to find the qualified workers. The supply chain problems we're dealing with isn't just a matter of finding people to unload the ships in Long Beach or Los Angeles. It is, I've got no place to put the containers after I unload them because I can't get truck drivers to take the containers and move them. And a lot of people don't want to go back into the job they had of driving trucks, long haul truckers. They don't like being away from home that much, even though they're paying, they can earn $75,000, $80,000, $100,000 a year driving these trucks. They're having trouble finding people to take those jobs. Because if you look at all of the studies that have been done in the last 6 months, and there have been several of them done, asking people what is the primary decision, what's the primary factor that makes you decide to take a job, by far that decision is flexibility. It's not pay, it's flexibility. People want to be able to work from home, they want to be able to work flexible hours. If I want to get up at 5 in the morning and work till 9 and go play golf, come back at 5 o'clock in the afternoon and work another 3 or 4 hours, that's what I want to do. I don't want to go into an office. Now, whether that's because they're afraid of vaccines and being infected by working in an office, that's probably a part of the factor. But the reality is that flexibility requirement that people have, lifestyle changes that they appear to be making at this point, is having a huge impact on getting people to go to work. Pay is, I think, in all those studies, people believe they're going to get a higher pay. They're going to get more money working somewhere as long as they can get the flexibility they want. So flexibility of their schedules and control of their time where they work is by far the biggest factor in people, what they say is the factor they decided on whether to take a job or not. So it's difficult to get people to work at McDonald's when I got to be at McDonald's for the job. That's not what I want to do. So that's going to make this wage increase continue at a rapid pace going forward. Anybody ever heard of the JOLTS index? See, you learned something here. The JOLTS index stands for Job Openings and Labor Transfer Survey. That's what JOLTS stands for. So every month the Labor Department puts out a report about the number, basically, of unfilled job openings posted in this country. That number has skyrocketed. We're up right now above 10 million posted and unfilled jobs in this country. Huge number. When historically we would run somewhere in the 3 to 4 million on average. So we're triple what we have historically experienced. There's a reason that people are not taking the jobs that are open and posted out there. And I think it has a lot to do with this flexibility question. It isn't a matter of pay. Now, this is also the survey where they reported in August, which is the last month this number's been out for, that 4.3 million people quit their jobs in the month of August. Why would anybody quit their jobs in this environment? Clearly it isn't because they want to stay on unemployment or they don't want to work, although I think some of them probably made that decision. It's because they moved to a different job. They got a different job offering them more money and a job that has a career attached to it. So I want to move to a job that pays good money, gives me flexibility, and is a job that I enjoy, as opposed to being stuck in a job I don't like at low pay with no flexibility. So I think all those factors are creating this slow recovery in the number of people willing to come back to work and taking jobs that were entry-level positions or were less than attractive to them in terms of the nature of the job. I've got a couple friends of mine who own landscaping companies. Try and find people who are willing to go out and cut grass or trim edges for other people. You can't find them. They're not willing to do that work. Heck, I'm not willing to do it at my own house, and I'm trying to find people who are willing to do it. So it's a difficult environment to deal with, but that in fact is the reality of why these job openings are going unfilled, because people are making a different lifestyle decision. And therefore you end up with this problem of participation rate. Now, the participation rate is often cited. And this is the percentage of people 16 years of age or older, which is the government defines as the workforce, who are actually working. From 2010 through 2019, as we came out of the Great Recession back then, that participation rate averaged around 65, 66% of people age 16 and over who were employed. It plummeted, obviously, with the closing of the economy. And as you can see, it's recovered, but it's only back up to about 61% in the total. We can't get that participation rate to increase at a rapid pace. It's another reflection of the shortage of workers that we continue to experience. And the participation rate, it may be greatly affected by people deciding that they don't need to have two wage earners in the family. They're willing to make less money, but have more time with family and at home, and all of those kinds of, their lifestyle may be more important to them now that they went through this pandemic and the shutdown of the economy. There's all kinds of reasons being cited for this, but the reality is we have far fewer people who are of working age who are employed and willing to work, even though we have all these job openings out there. So something is going on. And the question is, how long does this paradigm shift continue? It also has some ramifications for things like immigration policy. Maybe we need all these people coming in to fill these jobs. Maybe we shouldn't be so as adamant about keeping people out because we need entry-level people. It's certainly going to impact that politically, that decision, this participation rate problem. Now, what's the downside of this beyond what I've already described? The downside is inflation, because we're going to experience and have experienced a significant increase in inflation. As I said, the Federal Reserve said it's temporary or transitory, that it's going to settle back down. But after running an inflation rate for 10 years in this country, as the economy expanded, we ran an inflation rate less than 2%. The Fed says 2% inflation is their target. They believe 2% inflation is reflective of a healthy, growing economy. We should expect inflation of 2% in that environment. Well, over the last 12 months, the consumer price index is increased by 5.4%. The producer price index is increased by 8%. So you've seen an even larger increase in wholesale prices than we've seen in consumer prices. What does that mean? It means companies have reduced their margins. Companies have seen their input costs rising, labor costs, materials, everything else they buy. And while they've raised their end prices they're selling, they're raising them at a slower rate than the increase in their cost structure. That means their margins are shrinking. So in order to get earnings to grow, you have to increase volumes at a significant pace to make up for the margin shrink. How do I increase volumes if I can't get workers to help me increase my output or production? So it's a vicious circle. What it also tells us is we haven't seen the end of inflation. It's not transitory. It's not temporary. Inflation is going to continue well above the 2% target the Fed has into 2022 and probably 2023 or 24. it's going to take that long to rebalance the labor force and the output capabilities domestically with the demand levels. Beyond that, we've got to rebuild inventories. Companies have to get some products back in inventory in order to properly run their business efficiently. So this inflation issue is with us, and it's going to continue to be with us, primarily because of the imbalances that we've built up in the last year that we fully haven't compensated for with the rise in consumer end prices. So inflation continues to be a problem. The Fed uses as its primary measure of inflation, not the PPI or the CPI, they use something called the Personal Consumption Expenditure Core Price Index. That has risen at 3.6% over the last 12 months. And it's going to continue to rise at a faster pace going forward. It's risen less than the CPI of 5.4%, primarily because the PCE Core Price Index doesn't weight rents and housing costs as heavily as the CPI does. So it's a matter of how they construct the two indexes. But rents and housing costs are going to increase, have increased, and will continue to increase. Demand is much too high. We went 10 years in this country averaging about 500,000 housing starts a year, while we average 800 to 1 million new family formations per year. So you can't have that many, and they've redefined family formations, not the traditional measures that we might think of, but that's what creates demand for housing is the family formation activity. So we've been running 10 years where we underbuilt in this country. It's going to take a long time for that housing sector to catch up, both multifamily as well as single family homes. So the core PCE price index is going to continue to go up. That leads the Fed in a bind. And the Fed, as I said, was heavily weighted toward full employment. Now the problem with that is, what is full employment? What's the definition of full employment? For years, the introduction said 45 years, it's been closer to 55 years I've been in this business. But for 50 of those years, it was clear what full employment was. We defined full employment as a 5% unemployment rate. That 5% of the workforce was always in transition, between jobs, changing jobs, not necessarily being laid off, but just the normal transition in careers. So that if you had a 5% unemployment rate or less, that was full employment. Now that got kind of shot out in 2018-19 when we got down to 3% unemployment rates. So the full employment concept of 5% was kind of put aside. What the Federal Reserve has said is that their efforts have been to recover what they define as the loss of 10 million jobs during the pandemic, and that so far we've only recovered about 6 million of those jobs coming out of the full impact of the pandemic. So the Federal Reserve apparently is saying that their definition of full employment is the full recovery of those 10 million jobs. Well, we've already seen that that's not working out real well. We're not getting people taking the jobs that are there and are open, and therefore we're not going to get those 4 million jobs we're still short back as quickly as they thought, and the cost to get those people to go to work is going to go up more than the benefits of getting the other 4 million people back to work. That's their definition of full employment. So the Fed said until we get to full employment, they were going to continue an aggressive, accommodative monetary policy position. What the Fed did in the pandemic was lower the Fed funds rate, which dictates short-term interest rates, by 150 basis points. A basis point is 1/100th of a percentage point. They lowered them by 150 basis points, or 1.5 percentage points, in a 2-week period in March of 2020. So right now the Fed funds rate is 0 to 0.25. They have a range that they'll publish. They said we're not going to change that rate until we reach full employment. They also instituted a quantitative easing program, although they didn't call it that, where the Fed has been purchasing $120 billion a month in bonds in the market, $60 billion in treasuries, $60 billion in mortgage-backed securities. Well, the Fed was doing that because they wanted to keep intermediate and longer-term interest rates low, while their short-term interest rates were as low as they were. So that's an extremely accommodative monetary policy. Fed had said all along, we aren't changing rates or our monetary policy until at least 2023, possibly 2024. That all changed at the September Federal Open Market Committee meeting, which is when the Fed makes these monetary policy decisions. The FOMC meeting and the third week of September, the Fed changed its position. They sent every signal in the world that they're going to begin tapering, is the term they use, the amount of bonds they're going to purchase each month. In other words, they're not going to buy $120 billion a month in bonds. They're going to reduce that every month going forward. We expect, and the Fed has virtually said, that they will announce that tapering program at their November meeting, which is 3 weeks away. It'll be the second week in November. And I think really the reaction is going to be dependent on the amount of tapering. Do they reduce their bond purchases by $10 million a month in a $120 billion a month program? It's going to take a long time to have that have an impact. But if they reduce it by $30 or $40 million a month, then it'll have a much bigger impact. So, and the impact we're going to see is on interest rates. If we go back then and look at where interest rates were before we began the pandemic, this is the yield curve in December of 2019, before the pandemic, we began to shut down the economy. This is referred to as a flat yield curve because there's very little difference between short-term interest rates and longer-term interest rates. It was a flat yield curve. Over the course of 18 months and the Fed's monetary policy positions, look what's happened to the curve. It's obviously the biggest drop in interest rates occurred in the short end of the curve when we got down to 3-month Treasury bills at 5 basis points in yield, for example, and you got what is called a steeper yield curve. But all rates were lower in August of this year than they were in December of 2019. Well, what's happened to interest rates since the Fed sent the signal they're about to remove the accommodative monetary policy? Here's the curve as of yesterday. Interest rates have moved up. The curve has steepened even further with intermediate and long rates up. For example, the 10-year Treasury this morning is at 165 in yield. Okay? Why should anybody here care about that? The 10-year Treasury yield dictates mortgage rates, whatever mortgage rates may be. So what we've seen here since August is about a 35 to 40 basis point increase in the yield on a 10-year Treasury. That means mortgage rates have moved up. Now, we've seen a lot of mortgage lenders eat some of this increase. They basically have not increased mortgage rates as much as the 10-year Treasury has increased because they're trying to keep volume going. So instead of making the normal profit in writing a mortgage and selling it in the secondary market, they're taking less of a profit. They won't do that very long. That won't last. So mortgage rates are going to go up, and they're going to go up significantly. If the Fed announces a $30 or $40 million a month tapering program in 3 weeks, then you're going to see that 10-year Treasury jump up dramatically. The spread between the 2-year Treasury and the 10-year, which is sometimes referred to as the TED spread, has now widened dramatically from where it was at the end of 2019. The wider that gets, the steeper the yield curve, the higher will be long-term borrowing costs. And we fully expect these rates to continue to go higher. Largely because we think inflation is going to be well above the Fed's 2% target. We're looking at 4 to 4.5% inflation next year, slightly less than the 5% plus that we've experienced in the CPI over the course of the last 12 months, but certainly well above the Fed's long-term target of 2%. And we think the economy is also going to do much better. So here's our forecast for real GDP. As you can see, we've got a slightly lower level of GDP growth in the third quarter, which will be announced next week, at a little over 4% GDP growth, down from 6.7 growth in the second quarter, but then a better than 7% growth in the fourth quarter. The 4% growth is largely due to the surge in the virus that we've experienced, and that has certainly slowed some economic activity as a result of that. But we see consistent economic growth in 2022 of better than 4%, well above 4% in the first half of the year, and right just at or slightly below 4% in the second half of the year. Overall, we think we're looking at 4 to 4.5% real GDP growth in 2022, down from about 6% total real GDP growth in 2021, but still well above the average GDP growth of the 10 years prior to the pandemic of about 2 to 2.2%. So we're actually optimistic about economic conditions continuing to improve and improve at a faster pace than we experienced prior to the pandemic, but we also expect inflation to remain well above the Fed's target and what we've experienced over the 10 years prior to the pandemic. Well, the real question is, what are the risks to this forecast? First of all, the risk is the labor. Well, I shouldn't say that. First of all, we can't experience another surge in the virus. The virus infection rate, hospitalization rate, death rate needs to come down in order to reach a 4% plus real GDP number. As long as it does, then we have the opportunity to see those 4% plus growth rates. Then we need to see the labor market continue to recover. We need to see that JOLTS index come down. We need to see fewer and fewer unfilled job openings. We need to see more people willing to go to work. When they do, wage rates are going to go up at an even faster pace than we have, and costs are going to rise for companies, and companies are going to have to raise prices faster than they have in order to recover or cover those increased costs. So the labor market paradigm shift that we've experienced so far needs to abate somewhat in 2022 in order for our GDP and inflation forecasts to come out anywhere near correct or close. Supply chain issues, we need to continue to address those. We aren't going to correct those in the next 2 or 3 months. Dictating that ports go to work 24/7 is not going to correct the problem quickly. We are going to be short products in this country until we domestically increase industrial production and output. It's going to be interesting to see this process take place next year as companies try to react to continued high level of demand and the inability to meet that demand with domestically produced goods. But that's going to be the issue. So industrial production needs to increase at a fairly rapid pace. The trade deficit needs to come down or narrow. We need to satisfy more of our domestic demand with domestically produced goods and not rely on imports, because import prices are going to go up dramatically. Import prices are going to go up just because of rising costs. Containers that people use to put on those container ships have they're up more than 300% in cost in the last 6 months. So just the cost of transporting all those goods have risen, causing import prices to rise, or companies eating that differential. Trade deficit needs to come down as a result of all that, and the risk obviously is fiscal stimulus. What gets passed in Washington? Our forecast includes the $1 trillion highway, bridge reconstruction infrastructure spending. It does not anticipate any further stimulus programs beyond that. Now, we can argue all day long about whether Congress does or does not pass any kind of a social infrastructure program, but we're not anticipating any being built. As a result, we are not anticipating any tax increases in 2022. In our forecast, if they raise taxes, then our GDP forecast will go down and our inflation forecast will go up. And that's starting to get closer to a stagflation environment. Not the worst of all environments. The worst of all economic environments is deflation, which we experienced in 08 and 09. You all remember that. That was not fun. The second worst is stagflation. But we'll be moving closer to stagflation if they raise taxes next year. We're not anticipating that they'll get that through Congress. But that's a political forecast as much as anything else. Basically, I'm fairly optimistic. I'm optimistic about the pace of economic growth, about the ability of companies to increase output and production, about growth in jobs, wage growth will provide growth in personal income that will hopefully be at least at the inflation rate so that consumers and companies don't lose purchasing power with the value of the dollars they do have declining, but the increase in dollars offsetting that. So I'm fairly optimistic about next year. The question then becomes, on a longer term basis, what does it mean to this country to have $28 trillion of debt, federal government debt, in an environment where our total real GDP, or total GDP, not real, but nominal GDP, is $22 trillion. What does it mean to us when we owe $6 trillion more money than our economy generates in terms of activity in 1 year? There are some significant ramifications to us on a longer term basis, which get reflected primarily in interest rates. So certainly I would think interest rates in that environment will continue their march upward in 2022 and longer, given the fact that we've increased this deficit out there as much as we have.